Nature-related and biodiversity risk draws on leading global standards, including the TNFD's LEAP approach, the Natural Capital Protocol, and IFRS S1 and S2, to help financial institutions assess and manage biodiversity risks. With growing exposure through capital allocation, institutions must understand how biodiversity loss can impact asset value, credit quality, and regulatory compliance. The framework begins with identification and assessment, mapping dependencies, impacts, and financial exposures. Early warning systems enable real-time risk detection, while scenario analysis strengthens resilience planning. We then apply the AR3T mitigation model: avoid, reduce, restore and regenerate, and transform, and align all actions with regulatory disclosure requirements, ensuring robust, nature-positive financial governance. The framework takes into consideration the feedback loop effect of transition risks.
Starting off with the first component of the framework, we have the risk identification. The key drivers of nature and biodiversity risks mainly arise from land use change, agriculture and food production, pollution, and urbanization. Next, these drivers translate into nature and biodiversity risks. Physically, we see a degradation in land, ocean, freshwater, and atmosphere, and this leads to species extinction, habitat disruption, and even ecosystem collapse. Businesses also face transitional risks. To identify the most vulnerable industries, we have created a sectoral heat map, which is a weighted average metric where nature risks and financial risks are given a certain weight based on their importance. This has led us to identifying the most vulnerable industries to be the energy and utilities, agriculture and food, manufacturing, transportation, and infrastructure industries. For financial institutions, these risks translate into three key financial challenges: credit risk, market risk, and operational risk.
We outline the approach to assessing and quantifying nature-related financial risks, drawing on best practices from TNFD's LEAP approach and the Nature Capital Protocol. We begin with scoping and risk identification, defining organizational focus, value chain boundaries, and dependencies on ecosystem services, using tools like NCORE and IBAT. Risks are prioritized by sector, geography, and ecosystem service reliance, with outputs like materiality matrices and heat maps. Next, geospatial and sectoral risk mapping is used to overlay asset locations with biodiversity hotspots and degradation zones. This helps clarify risk levels and assess exposure to biodiversity-related policy and regulatory changes. Impact measurement and valuation comes next. Here, we quantify physical, operational, and liability risks, such as rising water costs or pollution losses, using techniques like market pricing, replacement costs, and scenario-based valuation. We then conduct scenario analysis and stress testing using TNFD's aligned narrative to model uncertainties and test portfolio resilience, with financial impacts assessed through Monte Carlo and discounted cash flow models. Finally, we integrate these insights into our risk management framework, using risk-weighted asset models.
We began by referencing the BCG Transition Risk Matrix, which estimates the financial impact of carbon pricing, expresses annual EBITDA at risk across regions and sectors. While insightful, BCG's model is region-focused and limited to a single driver, carbon pricing. In contrast, our framework adopts a sectoral lens, which we believe is more effective for transition risk analysis. This is because transition exposure is not only shaped by geography, but more fundamentally by industry-specific drivers such as emissions intensity, land use, and supply chain dependencies. We integrate two key transition drivers: carbon pricing risk and biodiversity-related policy risk. This approach better supports financial institutions in conducting stress testing and scenario analysis. Early warning systems are essential for proactive mitigation. This slide presents a structured framework for identifying, monitoring, and responding to nature-related risks in financial institutions. It is grounded in LEAP approach and aligned with IFRS S2, IFC, and the Natural Capital Coalition, covering 5 core risk categories, from credit to reputational. What sets our model apart are the bolded additions, including sector-specific risk thresholds, AI-driven stress testing, and emerging indicators like social media, activism, and legal action.
Mitigation strategies are grounded in the TNFD's AR3T framework, providing a structured way for financial institutions to manage nature-related risks. As these strategies are implemented, 4 internal priorities should be considered: scaling green solutions, balancing ESG factors, minimizing operational impact, and enhancing accountability, transparency, and engagement. This framework includes measures like exclusion policies to avoid financing high-risk industries, which helps to reduce exposure to stranded assets. Biodiversity risk stress testing enhances early identification of emerging risks, while sustainability-linked credit lines and biodiversity-linked credit loans incentivize clients to adapt to nature-positive practices. To further build resilience, instruments such as green bonds and resilience bonds mobilize capital for sustainable projects and biodiversity adaptation. Through collaboration with NGOs and regulators, institutions can align with evolving nature finance standards and strengthen market credibility. Together, these strategies mitigate credit, market, operational, and reputational risks, while positioning financial institutions at the forefront of sustainable finance.
Finally, this slide presents our approach to aligning nature-related disclosures with regulatory expectations. We start with the foundation of IFRS S1 and S2, which focus on materiality, governance, and integration of sustainability risks into financial statements. We then build on this using guidance from IFC and TNFD, particularly around double materiality, consistent metrics, and transparent stakeholder engagement. Our additional recommendations in the last column aim to close current gaps. These include defining sector-specific thresholds, requiring third-party impact audits, and establishing board-level oversight to ensure strategic accountability. We also propose stronger financial linkages, such as nature-linked instruments and adjusted capital requirements, to embed environmental considerations into financial decision-making. Overall, this framework enhances both regulatory alignment and institutional readiness.
Look at how the biodiversity risk framework is being applied into the real world, especially within the financial sector. First, financial institutions are now facing growing exposure to nature-related risks, driven by regulatory pressure, investor expectations, and the physical and transition risks tied to biodiversity loss. Second, these risks are being factored into the financial decision-making, especially through credit, operational, and market risk assessments. For example, biodiversity loss can reduce loan recoverability or create standard assets. Third, sectors like energy, agriculture, and infrastructure are highly dependent on ecosystems. So financial institutions are using tools like TNFD split approach to assess portfolio-level impacts. Fourth, nature-based solutions are gaining traction, with green bonds, biodiversity-linked loans, and insurance products, helping firms align with climate and ESG strategies. Finally, case studies from the French Central Bank, AB Namuro, and DNB Bank show how real institutions are embedding biodiversity into risk and investment frameworks, signaling a shift from the theory to implementation.
Maturity risk matrix below allows us to compare different implementations across banks. Institutions are divided across 4 categories: leading, maturing, emerging, and nascent. The leading top quartile are banks that comply with over 75% of the framework standards per item. The nascent bottom quartile are banks that have a minimal compliance level. For risk identification, Barclays uses its proprietary Blue Track framework to measure emissions and uses tools like the IBAT for biodiversity risk. However, the TNFD LEAP is a more leading standard that hasn't yet been implemented. Assessment-wise, they run limited scenario analyses on biodiversity risks and do not employ stress testing or Monte Carlo simulation models. Furthermore, no real-time monitoring is implemented and geospatial analytics are omitted. Importantly, Barclays does fully align with all major sustainability accounting standards and are independently audited. Overall, this places their framework in the maturing phase of the risk matrix.
Maybank is currently in the emerging category for risk identification and assessment, lacking geospatial biodiversity risk mapping and biodiversity-specific financial modeling. To improve, it should adopt satellite monitoring, the TNFD LEAP framework, and integrate biodiversity dependencies into their ESG risk models. For risk monitoring, Maybank is nascent, lacking biodiversity KRIs. Geospatial analytics and early warning thresholds should be introduced. In risk mitigation and regulatory compliance, Maybank remains emerging, offering only ad hoc biodiversity-linked financial products and lacking risk governance linkage. Developing biodiversity-focused financing and establishing a risk committee are recommended. However, Maybank's reporting and disclosure are at the maturing stage, but full TNFD alignment is needed. Its biodiversity-specific reporting should be further expanded and must integrate a double materiality assessment.